Well, hello, this is Jim Musgrave, and welcome to my market summary call for March 2017. So today is March the 8th, which is the 8th year anniversary of this strong bull market that we have been in. What a difference 8 years will make. So, will the stock market continue to climb? Well, I think it will. We actually had all-time highs on the S&P 500 and the Dow Jones Industrial Average. So will the Trump rally continue its blistering pace, or are we headed for a downturn? Well, my indicators say that we're actually nowhere near a bear market recession. This is a chart of 10 economic indicators. You can see here in the last recession it was really bearish and horrible, but you can see that we're still in the positive territory. In fact, we've had a little bit of a tick up in our economic indicators. So this is a good thing. So again, markets don't go in a straight line, so we're most likely going to have a slight pullback. But I think overall things are very bullish right now, so that is a very positive sign. So what about the interest rates? Well, the Fed is expected to raise interest rates in March, but what does that mean for your portfolio and your pocketbook? Well, remember that rising interest rates are a double-edged sword. So as interest rates rise, we earn more money in our savings accounts and CDs, and that's a great thing for retirees on a fixed income. But it also means that it costs more to borrow money. So interest payments on your credit cards, your mortgages, and your home equity lines of credit are going to go up, and that means more discretionary income that goes out of your pocket. So again, the Fed definitely needs to normalize their interest rates, and I think the projected estimated number is going to be roughly 3 increases here in 2017. Again, this is long overdue, and the Fed definitely needs to get to some level of normalcy in their interest rates. So I'm going to break down what's going on in the stock and bond markets and give you some tips on how to make money and also how to keep more money in this market. But before I do, I'm going to give you a slight commercial. As you may know, I am the regional president of the Baltimore, Washington chapter of the nonprofit Society for Financial Awareness. And so it's my job to go out into the community and teach financial education. And we have a brand new website. Again, the website is www.b as in Baltimore, W as in Washington, sofa.org. That's www.bwsofa.org. And you can click up here about, to learn about us. We have 30 different topics of seminars, and I actually just added a topic to help business owners on how to evaluate their 401k plans. So I'm very excited about that. So in addition to a brand new website, I actually created a new Facebook page for SOFA. So if you go on Facebook and you type in bwsofa.org in the search bar up here, my Facebook page should come up. And so what I'd like you to do is to search for that and actually like this page. Okay, so it is in your best interest to do so. Why? Because I'm posting great information on this on a weekly basis. For example, my last post was on the IRA rules in your contributions. So just to give you a reminder of that, so you have up until April 15th of this year to make a contribution to your IRA for 2016. So again, if you're under the age of 50, the limitation is $5,500, and if you are age 50 and above, you have the catch-up provisions, and you can put up to $6,500. Now, if you're putting money into a tax-deductible IRA and you're single and you make $62,000 or less, you can get a full deduction. So every dollar that you put into your IRA, that's $1 off your income taxes. For singles, it's the phase-out is at $62,000, and for couples, it's $99,000. Now, if you want to contribute to your Roth IRA and you're single and your adjusted gross income is $118,000 or below, you can contribute to a Roth. And if you're a couple and your adjusted gross income is under $186,000 a year, you can contribute to your Roth. So just give you some tips on the IRA limitations and some of the deductions and limitations that you have. All that stuff is really important. So you can also see right here, I posted a video on what happens when interest rates go up. So it's a short 2 or 3 minute video, professionally done, that just kind of explains how interest rates work, when they go up and down. So I'm posting great information. And also just to let you know, I've given dozens of workshops over the last year, and I've had over 400 attendees attend these workshops, I've met with over 70 people, and each one of those attendees who attended my workshops and met with me have a financial roadmap, and they are on track to kind of reaching those goals more effectively and efficiently. And so again, I encourage you to come to the workshops, and this is also where I could use your help. April is Financial Awareness Month, and so I could use your help to line up financial workshops in your work, in the nonprofit or an association, or you're a church that you're a member of. And so if you could introduce me to the person who books the continuing education workshops, or the HR person, I think you would really be helping out a lot of people to get this very, very valuable information that can literally change their lives in a positive way. So again, if you could like the Facebook page, and just send me an email about if you can introduce me to anybody in your human resources department, I'd be happy to set up a workshop in your place of business. Okay, now enough for the commercial, kind of moving on to the market forecast. So this is a great slide that kind of shows the last two recessions on the bull market. Again, you can see March the 9th, 2009 was the very, very bottom of the market. It marks the end of the bear market in 2009. And again, the S&P was at 667. And as we speak, it's up over 2370 at the moment. And that's a huge rise. So again, the market has climbed over 231% from March the 9th, 2009 to December 30th in 2016, which is a huge run. So for those of you who are just scared not to lose money and kept all your money in fixed accounts over the last 8 years, you made a huge mistake. I mean, look at that rate of return that you missed out on. Okay, so I occasionally see that. So again, markets don't go in a straight line, but you can see over time they really do, grow substantially. So again, with the bull market continuing at this point, you definitely need exposure to stocks to keep up with taxes and inflation. Okay, but with that being in mind, you always have to keep the bear markets in mind when you're putting together a portfolio, and you have to understand the risk. With that being said, you can see all these different bear markets right here. But what I want you to focus on is where my mouse is here in the lower right. So this current cycle, again, this is as of December 30th. This bull market has been going on for 95 months. And so actually right now it's over 97 months, which is the second longest bull market since the Great Depression. The only one that was longer was the one in the late 90s that went on for 115 months. So with this being in mind, this bull market is a bit long in the tooth. No, we're not going to have a bear market anytime real soon, but again, you have to have a plan for when it happens. And so every year that goes by, the chances of the bear market happening increase a lot. So again, that's one thing that we always have to look at when putting together a portfolio, is that what is your plan of action when the next bear market happens? And as you know, we use technical analysis and we have a sell-side discipline. And so our number one priority is to protect your principal when things start turning south. And we just know it's a matter of time before that happens. Okay? Now, why is that so important? Well, because it takes so long to make up for the losses. So if I had a $100,000 account and it dropped 10%, I need an 11.1% return to get back to break even. Well, if you look at the last two recessions, the S&P was down roughly 50%. The last one was down 57%. So if you had a $100,000 account and it dropped 50% and now you're down to $50,000, you need a 100% rate of return to get back to the break-even point. Folks, I don't care if you're 20 years old or 90 years old, you don't have the time to make that up. It doesn't make sense to have those types of losses in a portfolio. So again, you need to have a strategy to kind of deal with that. Now, obviously the market has to breathe, but at what point is your threshold of getting defensive? Typically it's around 10 or 15%. Much beyond 15%, that's very, very uncomfortable, and it's going to take quite a bit to get back to the break-even. Okay, and as I mentioned, again, we are not in bear market territory. Things got a little close in 2015, but again, things are okay for the now. So I just want to kind of reiterate now's not the time to be defensive, but just be aware that a big pullback will happen. It's just a matter of time. Okay. Now, just a quick summary of what has been doing well in terms of the different sectors. So what I did was, this was as of Monday, the 6th of March, and these are year-to-date numbers. So right now, what's doing well in terms of my major indices is the NASDAQ, and these are the ETFs that you can buy. But you can see the NASDAQ is up over 10% year-to-date. The big surprise is emerging markets, and that's up over 9% year-to-date. And that's one of the things that we've been heavily underweight international in emerging markets for a number of years, but we've started to get a little exposure to international and emerging markets, and you can see the reason why. So the stocks abroad are less expensive and have been beat up, and now we really see some opportunities to kind of diversify into international at this point, and you can see that by these returns. Also, technology, no surprise, is doing very, very well, and followed by healthcare. Now, it's going to be interesting to see what happens with the healthcare stocks with Republicans trying to repeal and replace Obamacare. So that's a bit of a question mark right now, and so it remains to be seen on what happens with the health insurance sector. And kind of moving on, obviously, with the rise of interest rates, financials are doing very well. So having some exposure to financials, kind of moving forward, I think is a smart play, because obviously, if you're a bank lending money and the interest rates go up, that means that most likely your profits are going to go up in your bank. So having some exposure to financials is good, and you can kind of see down the line you have consumer discretionary, which is strong. That means that the average person is buying goods and services. Industrials, consumer staples. Utilities were actually fantastic. They were one of the strongest sectors in the first half of 2016. Then they completely fell off the bed in the second half, but they're starting to see a little bit of life here in the first couple months of 2017. And you can see the S&P 500, our benchmark, is up just shy of 6%. We also see that the international is about a percent behind the U.S. stocks. What is interesting is that if you look at small cap was one of the strongest sectors last year, and the last year is up over 25%, but it's actually kind of flattened out in the last couple months here in 2017. But again, that's no reason to sell your small cap if you have a diversified portfolio. Again, it's just after this huge run-up, it's certainly very natural for sectors to kind of take a little bit of breather before they start picking up steam again. And again, here's the bond index. Again, the AGG, which is the Barclays Aggregate Bond Index, is actually down 31 basis points year to date. Why is that? Because of rising interest rates. Remember that interest rates go up, bond prices go down, and so you're going to see that there's going to be continued downward pressure in bonds. And in the worst performing sector right now is energy. But again, the XLE is more of a broad-based sector. It's not just oil. It also has many other sectors within the energy sector. So that's down roughly 5% year to date. Now, I just wanted to, this is a great slide. So I went to the ETF conference down in Hollywood, Florida in January, and one of the presentations had this, and it was so good because it visually shows you what's happening within sector rotation. So this is a chart that shows all the major sectors and how they rotate going back 25 years from 1990 to 2015. And what's interesting when you look at this is that there's a 43% average difference between the best and worst sectors annually over the 25 years. And so you can see in 2015 that I guess consumer discretionary was up 10%, followed by healthcare. But you can see that that's not always the case. And this is a perfect example. You go back to 1990, 1991, you had healthcare up 17 and 54%, Look what happened in 1992. It was the worst performing asset classes at -16, -8, -8. So what this really illustrates is that there's two different ways that you can deal with this within your portfolio. One is that you can just do a buy and hold and buy a target date fund or an asset allocation fund where you buy all the different asset classes and you're just going to hold everything, and you're just going to kind of buy and hold, and it's just going to gradually grow over time. That's one way to do it. But what the professionals do is that we want to buy the strongest sectors at any given time and not own the losers. And that's really what tactical and professional money management is doing. That's quite frankly what we do. But again, the main thing I want to kind of point out on this slide is that there's a huge difference between the best and worst sectors, and you have to ultimately figure out as an investor, what makes sense for you. Okay. Now this is a little small, a little blurry, but what this is the same kind of chart, but this green horizontal row right here is the S&P 500. And what's interesting is that you go back to 2000 and 2008 during the last two recessions, you can see that there are many sectors that outperform the S&P 500, especially in a down market. But when you look at the last 4 years, it's been very, very difficult to beat the S&P 500. And I think a lot of that has to do with the index and the trend of people, buying more index funds, and so it's harder and harder to kind of beat the S&P 500. With that being said, if you look at last year, high-yield bonds actually beat the S&P 500 last year, as well as small cap. So again, from a risk management and a diversification perspective, you still need to have a diversified portfolio. You just can't put 100% of your money into the SPY ETF or VOO, or these are just ticker symbols that I'm throwing out there of the S&P 500. Why? Because at some point, the S&P 500 is going to go into another recession, and again, you have to look at the long term on a risk-adjusted return. So again, you still have to be diversified. You still have to have exposure to other asset classes. But it just is interesting that it's been, in the last 4 years, increasingly difficult to to beat the S&P 500. But obviously, it can be done. And again, having exposure to real estate and high-yield bonds and small cap and so forth, you definitely need to have that, because again, those are sectors that will outperform it at some point. Now, we can do the same thing with the fixed income. So I put together this quilt based on the major bond indexes. And so again, this was as of the end of February, and the AGG, which is this pink right here, it was flat last year, but you can see all these other sectors within the fixed income that outperformed it. So we have corporate bonds, we have a emerging market high yield, we have bank loans, and we also have just high yield bonds. And so right now, in a period of rising interest rates, it definitely makes sense to have riskier assets in your fixed income portfolio. Otherwise, you're just not going to do anything. As I just showed you, that the AGG is down 31 basis points year to date. So your fixed income part of your portfolio is there to act as a buffer for the stock market volatility, but you also want to make money. So you have to be very tactical in your fixed income model, and nothing explains that better than looking at the TSP plan. Again, my wife is a federal employee. She works at the Department of Justice, and so I'm very, very familiar with the TSP and have a number of clients who are federal employees and have this. And so I'm just bringing this point up because the TSP has basically 5 different asset classes. The G fund, which is fixed, the F fund, which is basically the AGG, the bond index that I just talked about. The C fund is the S&P 500, and the S fund is basically the entire stock market minus the S&P 500. And we also have international, which is the EFA, the ETF that I just showed you. Then the L funds is just a combination of all that stuff. So when you actually look at the performance of the G fund, again, this is at the end of January, the G fund has only done 1.83% over the last 12 months, and then the F fund has done less than that over the last 12 months. And so again, the F fund is going to actually have a worse return moving forward, because as you know, interest rates going up, bond prices go down. So if you are in the TSP and you're a federal employee, I would, if you're going to have stuff in fixed income, I would not be in the F fund right now. If you want to take some money and put it into kind of fixed, then be in the G fund. That makes a lot more sense, for that. Now, again, the problem is that many investors will keep a substantial portion of their portfolio in fixed income accounts to minimize losses. But by doing so, they increase the inflation. They increase the inflation and purchasing power risk. As I showed you, that the SP is up over 231% since the last recession. So again, keeping a substantial amount of money in fixed income, especially in the G fund over the long term, is not a smart idea, especially in the strong bull market. So again, the danger is literally in dollars and cents is that long term, by keeping substantial monies in these fixed accounts. Now, it doesn't matter if you're in the TSP or just in your 401k or other investments, is that it can mean the difference between living the lifestyle that you desire in retirement and actually struggling, and that's just the fact. So again, that's why having a diversified portfolio, even if you're already retired, you still need to have exposure to equities to keep up with taxes and inflation. So another little thing on the interest rates, I love showing this slide because it shows you the impact of a 1% rise in interest rate, what the impact is on different sectors. So on a 1% rise in interest rates, it means that the 10-year Treasury is going to drop 8.6%. Okay, so the Fed will most likely rise interest rates in 25 basis point increments. So it's possible that we go up 75 basis points just this year in 2017. Okay, so that's going to put a lot of downward pressure on bonds. So one of the things that I was kind of mentioning is that you definitely need to diversify and be in the right sectors in your fixed income. Just look in 2016. High yield was up over 17%. Corporate bonds were up over 6%. Floating rates, again, they tend to go up as interest rates go up, where it was up just under 3%. Convertible stocks, convertible bonds were up over 11%. Okay, so these are the sorts of the types of investments that you need to have in your fixed income portfolio. And if you're in the TSP, you're not going to have those in the G and the F fund. So again, that is one advantage of having professional money management, because you have access to sectors that are, quite frankly, making more money than your fixed accounts. Okay, so I just want to go over a couple other things. I'm going to wrap things up. So again, here's my here's a 6-month chart, and here's a 10-year chart. So here's the S&P 500. You can see that this rally really began right at the election, and we've had a beautiful rally right now. Here's the 8-day moving average, and here's the 17 and the 30. So you can see this is very, very bullish. As you can see, that we've had a bit of a pullback in the last 5 trading days, but the RSI is still negative. But you can see that the momentum has been dropping a bit right here. But hopefully this will kind of flatten out and continue to go up. Long term, you can see again, this is the bottom of the S&P 500 at 666. We're at the high was at 2,400, and this is my 200-day moving average. And so you can see right here at election day, we got our green arrow, and we continue to be very, very bullish. I mean, look at the gap between the 200-day moving average and where we are. So this is very good, and you can see right here that we are strongly in bullish territory. So that's a very strong thing. So again, we have the S&P 500. The same thing is the case with the Dow Jones Industrials. Again, the Dow Jones took off at the same time as the S&P, but it's acting identically to the S&P 500. And again, we've had a bit of a pullback the last 5 days. You can see that our momentum is starting to drop. And here on the long-term chart, again, we had the green arrow here last November, and we're just very, very far above the 200-day moving average. Now, what's interesting is that here's the Russell. So the Russell, this is a great chart. You can see over here on the left that the Russell had a huge return in the last 6 weeks of the year. I mean these days right here in November were just crazy. And so again, the Russell was up over 25% last year, but it certainly has kind of flattened out. And again, short term, we've actually broke the 30-day moving average. So this is certainly some weakness in small cap at the moment. Again, it's not, we're not to the point that you need to sell and bail. Again, this is the market is breathing, and this is certainly very natural after a very large run-up of 25% last year. So again, I'm not worried about small cap totally falling out of bed right now. Yeah, we have broken the 30, but you can see that the RSI, we're starting to turn up a little bit, and my guess is that we're going to start to get, it's going to kind of hit some resistance maybe right around here at around 1357 and kind of bounce back. That's my guess of what's going to happen. Another good thing about the technology heavyweighted and NASDAQ, I mean, look at this beautiful line. So the NASDAQ is definitely going up. Again, we have a nice little uptick right here. Same thing we've got in my long-term chart. We had some nice green arrows. We're far above the 200-day moving average. NASDAQ is looking great. And to kind of move on a little bit, we have international. We're still looking pretty good on that as well. So again, we're far above the 30 on the short term. You know, again, we're taking a little bit of breather in our international stocks. And you can see, you know, why we've been somewhat underweighted in international. Again, we kind of peaked here in 2013, and then we had a lot of choppiness and kind of rallied it, but it's just really kind of dropped off in last, you know, mid-2015. But you see we've had a nice rally in our long-term chart this year. And so again, so when the market has been, you know, beat up as much as it has been overseas, we see some opportunities. So now it might be a nice entry point into international. And as I mentioned before, emerging markets, same kind of story. Look at emerging markets back here in 2007, just going crazy. But look at what happened during the recession. I mean, that is just one of the ugliest falls, you know, that I've seen. But you know, obviously, emerging markets had a nice run, but the choppiness here in 2010 and just the continued falling is just a lot of chop, So, you know, as you can see right here, emerging markets is a very, very volatile asset class. And so you got to be very careful with it. But, you know, when emerging markets is up, you can really add a little bit of juice to your portfolio. And you can see we got the green arrow here. And, you know, again, on our weekly chart, this is looking nice. Yeah, we've had 3 weeks of a bit of a pullback, a little bit of a breather. But, you know, overall, we're still fairly bullish. You know, so, you know, this is more on our short-term chart. And we're just kind of hit the 17-day moving average. So, I just lost the thing right here. So anyway, my point of all this kind of stuff is that we're looking pretty good with the with all the indexes. Let me see if I can log right back here in my software. And sometimes I do have these little glitches, but I should be back in line in just about 3 seconds or so. All right, here we go. So we're back online. And the other thing I wanted to show you was gold. And, you know, so we had a huge run-up in gold back in 2010. Actually, last year was actually a very nice year in gold for the first half of the year. And then it just completely fell out of bed, broke the 200-day like crazy, broke it. And now we've had a nice little rally, but things are starting to kind of roll over again. So, you know, gold is one of those things. A number of people feel that you should have a small allocation to gold in your portfolio, and that's probably not a bad idea to do. Again, you're going to have some choppiness in right here, but I think you know, gold is one of those uncorrelated asset classes that can tend to do well as the you know, as the market kind of has these dips, and as the dollar gets stronger and as interest rates go up, gold can be a good place to be. And last thing I would just want to share with you is that we have the VIX. And so when you look at the VIX as the volatility index, you know, you see these extreme levels back in 2008. You know, again, this is a lot of people selling, but, you know, you look at, you know, the short-term chart, we've had historically low volatility in the market. You know, we've had these little spikes here, you know, last fall, obviously when things have been kind of, you know, selling off, you know, periodically. You know, this was August of 2015, and this was, you know, a bit of, actually that was August 2015. This was the beginning of 2016. You can see that the volume is, a lot of volatility has been pretty low. So that's actually a good sign. We like slow and steady. So again, my recap on this is that, again, stay diversified. This is not the time to get out. I mean, if you want to lock in some profits, you can, but I think that this market has some legs to run on. And if you have some new money that you want to put in the market, well, you can certainly look for short-term pullbacks. Again, here's the SP 500. We've had a nice little turn back, a little pullback, and so now might be a good time to put money in because we've had this little pullback in the last maybe 6 or 7 trading days. So again, that's all I want to cover here in this market report. Again, if you have any questions, you can always send me an email to jim.musgrave@rfsadvisors.com. And again, just to kind of plug my little commercial, please go on to Facebook and like my SOFA page. Again, I post lots of great information on there. And again, I could really use your help to line up these financial workshops in your company, in your groups, your churches, your nonprofits. Again, I've been helping a lot of people, and 100% of the people who attend the workshops and I've met with have just thanked me endlessly that I've helped them get on track financially. So again, you could help other people by just introducing me to an HR person or somebody who can book these workshops. Again, they're free. There's no cost. It's an added benefit. And I'm not here trying to peddle my services. I'm just out here trying to spread the love of financial education. Okay, for now, I'm going to sign off, and I hope you liked this video, and I will see you next time. Take care now.